We now would like to invite Mr. Laxman to enlighten us about the scope and the opportunity of private equity in India.
Thanks. Hi, good afternoon. Thank you. I think most of us feel this way, so I thought might as well be frank and upfront about it. I would have, if I were in your place, the food here is good. The idea of today's presentation is to just give you a perspective of the size and scale of private equity in India, a little bit of where it's headed, and throwing in some numbers to give you an idea of where it stands. I'm not going to bore you with things like what a private equity fund is, what it does, and what I do for a living. If there are specific questions, we can always take it up in Q&A. This is more to give you a broad view of what this business is all about. Now, just to wake you up, here is a number, 8 billion US. Now, if you're a traditional guy like me, you always run parallel processing in your mind. You always convert billions into crores and crores into billions every time you speak to an investor or to a company, roughly 36,000 crores. So that's a big number. That is the amount of money private equity has put into India in calendar 2010. And to put it in perspective for you and just to compare, this year, again, till now the number is roughly the same, about 7.6 billion. And the total amount of money raised by companies in IPOs, follow-on public offerings, all of that put together, this year to date, calendar, is not more than 2 billion, roughly. So this is the whole idea, is to just to put it in perspective in terms of the amount of money that's actually being pumped into companies, businesses, ventures via private equity. And in these calculations, if my memory serves me right, I've not included real estate in this. So this is without the real estate boom. Great. So just to give you a perspective, private equity in India is actually a very, very young business, very young segment. It started maybe a little earlier, but it actually began to catch steam more in 2003. And by 2007, India shot to the top slot in Asia Pacific market, including Australia. And after a lull in 2008 and 9, we have seen the largest increase in deal activity in entire Asia Pac region from India in terms of growth. They are double digits. I think they are 25+%. Indian fundamentals continue to remain attractive for PE investors, and whatever we may speak about our growth rates, inflation, about our stock market being high or low, etc., the overall sense that we get is that private equity investors are still happy and willing to put money in Indian businesses. That's the long and short of it. And Indian promoters are also gradually beginning to recognize PE as a patient source of active capital. And therefore, they are seeing a value proposition in it, because it's not money that is there for 1 month or 6 months. It's slightly long-term money, 4 years to 7 years. And it's not money that somebody gives you and then forgets about it. We will see in a couple of slides that I've put through in terms of how they can add and do add value. And governance standards have to continue to improve if Indian companies and promoters wish to attract future capital. A lot of it has been said and written about this. I think in spite of that, as a country, we are fairly, we are least sensitive in terms of how investors perceive certain decisions we take in companies and businesses with respect to the governance. That is more in terms of a mindset change rather than in terms of complying to a particular letter or a particular regulation in law. Some numbers to tell you how this 8 billion came up and how the history has been. If you see the deal value, in 2006 we were about 7.5, then you had a superb year in 2007, then we had a dip. Up to 2010, it's been a little bit of a down in 2009. But in 2010, it has been 8 billion roughly. And during Jan-August, the total value of deals done has touched 7.6. So effectively what you're saying is we have achieved in roughly 7-8 months what 2010 did as a whole. And even the number of deals are exactly similar in terms of proportion, except that the deal size has gone up. But just to quickly touch upon where all sectors have private equity investors been looking at. If you see calendar year 2009, you see calendar year 2010, you'll see that it's largely the big boys are from energy, banking, financial services, insurance. That could be also because of the size of the industry, because the size of the respective industries and how much money a PE money it can absorb. Because largely PE money in India even now is minority. It's not something where you take controlling interest and buy out stakes. So if you want to take a minority stake as well as put in large money, effectively it'd rather be a big segment or a big industry. But then you have telecom, you have engineering, healthcare is pretty consistent in terms of investment, and that is something which is actually, just to deviate from the topic, it's actually doing a huge amount of change that it's coming about in hospitals and companies that are not listed in terms of attracting private money to grow, reach scale, and then probably go public. And probably that's something is a direct impact of how private equity money in healthcare sector is going towards tier 2, tier 3 towns, setting up hospitals, of course profitable ones, still create, and then addressing a need that hasn't been addressed probably by the government part of it. If you see even the deal sizes, India is slowly maturing. In 2008 it was 23 million, then it dropped. In 2010 it was $24 million is the average ticket size of deals that are happening. If you see the current year, I just ran the numbers yesterday, it is about 28.5 million. So effectively, number of deals are increasing. This total quantum of money that's available for investment into Indian business is increasing, and the deal size is increasing. And in private equity, if you can call it private equity, but loosely, you have various stages in which a company gets funding. So this is just a breakup of those different stages. And if you see among venture capital, private equity, pipe deals, buyouts, you will see that the private equity piece has been growing pretty fast, and it has remained a pretty large share in 2010. Not a theory class on private equity, but a quick summary in terms of these three buckets of people who are normally players in this business and how they end up bringing about this entire industry. If you see on your slide, the left-hand side box, which is all your investors, which Raj also spoke about how in US, Raj, you said 0 interest and then you don't know where to put your money. So those monies do get allocated to various countries, geographies, market based on risk portfolio, and also of course in asset classes, equity, debt, leverage, whatever. So these are these investors you have on the left hand side. In the middle you have intermediaries. You have your limited partnerships. Typically private equity businesses are either managed by independent partnership organizations or they are managed by affiliates of financial institutions, such as where I come from. Then you also have small business investment companies, and you have publicly traded investment companies. All these guys effectively end up aggregating this money and then invest in probably new ventures, which is effectively early stage kind of businesses, or they invest in middle market private companies, which is the money can be used either for expansion, for changing of a capital structure, or change in the ownership, where you are getting out an existing investor and owner and getting in a new owner. Or it can be in public companies where you do a management or a leverage buyout, or you do a financial distress funding, or you do a special situations largely. So this is how the money flows, and effectively that is how the returns also go back. These businesses on the right extreme end up making money, then they give a lot of their all the money and the return in structured in whatever instrument you want to the intermediary here. Based on performance, as Raj also mentioned, in terms of your fee structures and carry, they keep some of the money if they do well, and then they return the money back to the investor. Long and short, this is the structure globally, and this is what the structure followed in India as well. Of course, there are variations. You have onshore funds, you have offshore funds, you have domestic and foreign funds structured together investing in a company in India. You have funds that are registered under SEBI or funds that are not registered under SEBI. It's not compulsory as of now. So these are all variations, but broadly this structure will remain in terms of what you see in terms of private equity. Now, you can classify private equity funding by various ways, either by how you structure the funding into the company, which we'll come to, or something like this, which is based on the stages of investment. You'll have a seed stage, then you'll have a startup stage, you'll have expansion stage, recapitalization, maturity. Normally, if you see in typically markets how it evolves, you will see that this follows a typical progression. You will have seed capital where the equity money is high venture, high risk. Obviously, returns are also as high. Then you go into startup stage. Then you go into expansion of capital. As your business matures, you will take out some existing investors and new investors will come in to carry on in the growth stage of the company. Then when there is a fair amount of maturity or stability in the business, then you go for IPO. Typically, why I'm saying all this is because later you'll hear that in India what happens is people end up mixing up all of this and says, Pele, let's go to the capital market and figure out whether you're going to get money. And then we'll see if I don't get money, I'll see if somebody like Bank of America is going to give me a loan. If that's also not possible, they say, okay, how about private equity? See, what happens is you end up putting the cart before the horse. So you end up probably just upsetting your own expectations vis-a-vis investors, returns and all of that. And it's also added because of the fact that in India you have a fairly mature capital market. You have a capital market probably that's more mature than any of the other alternative financing mechanisms that you have in India, like either a hedge fund or fixed income market or private equity. So invariably a promoter or a company ends up going to the market first. I will just put down a few ways in which a private equity can fund investments. The red box is where the private equity money comes from. The most easiest and the traditional one is you have private equity money, it comes into the company. The PE fund invests into the company directly. On the right hand box, it can come through a special purpose vehicle where the company itself splits its operations into various businesses and bifurcates the business where it wants growth capital or it wants money for an acquisition or whatever else, and then you get private equity arm only into that business. The third, the left hand side box at the bottom is more wherein you say the PE firm or the PE fund comes at the holding company level and then it has various businesses below it and you invest at the top so that you get to participate in the upside of the various businesses. The point here is what we are saying is that PE definitely has established itself as a strong source of funding. It has demonstrated that it can be a meaningful source of funding, and promoters do realize that certain values it brings to the table. For example, now fortunately PE has spent time in India and therefore there is a fair amount of consensus on the fact that it does get in financial discipline, it brings financial skill sets to the table. Definitely it gets in good governance because PE funds bring in with them their own standards, with their own parameters that can be measured in terms of how governance works in companies. It gets in systems and processes, it gets in business processes as well. In fact, there is a fair amount of value add which I have experienced firsthand in terms of where companies have benefited from disciplined business processes which private equity investors bring in. They do add industry expertise and also bring to the table the network that they have, either domestic or global, in terms of what they can do for the company. Because these companies are mostly, they are so busy in managing their own business and their own growth and running behind banks to get their own working capital enhanced, that they really don't think about how do I go out, how do I network, how do I see if alternative sources of business opportunity or new product lines can be established. PE funds also bring a rigor to the investments they choose to make, including business diligence, promoter checks, company background checks, due diligence which can be legal, financial and all of that, and of course investment monitoring during the phase of the investment. And because they're going to be staying there for 3 years to 5 years or 7 years, whatever that period is, there tends to be an amount of in-depth involvement between the PE fund and the sponsor. And the key thing to do is whenever you're structuring a deal is to ensure that there is dovetailing of interests between the shareholders of the company who are existing and the PE investor. That way you don't have to actually fight every boardroom battle with respect to is it yours or mine. It has to be, if there is a dovetailing of interest and you structure your investment such that your promoter grows, your company grows and you make money, that's probably the most ideal way in which you can manage that investment going forward. So therefore PE funding is not just an alternative if bank loan or IPO does not come through. So that is something which is a maturity that is slowly coming into the Indian market, but every time the market hits an index of whatever, 18,000, 19,000, 20,000, whatever you take it, then promoters and companies leave everything else and they say, I want to do an IPO. So my other part of the business, which is the investment banking business at Kotak, get very busy. So that's how it happens, but hopefully it's getting in some amount of maturity. What's the way forward? What are we thinking and what it's going to be? Just to throw some numbers at you to get you an idea of sense and scale, recent studies have said that there's a lot of dry powder as per industry watchers, which is the substantial amount of capital that is committed but not called. And this is to the tune of 20 billion. If you remember the first slide I put, 8 billion itself was a huge number compared to what we were capable of absorbing. You have 20 million of dry powder which are ready, not yet called, to be allocated into emerging markets like India. That's a lot of money. If all of that money comes in, then for the next 3 years, you don't have to do any other source of funding. You can just go through this. So that's the positive side of it. However, there are a huge number of PE funds are currently on the road. As per the last estimate, it is something like 100 plus who are actually on the road trying to raise money. And the total, if you add up all that these guys are speaking about, saying that we will raise 500 million or 1 billion, if you add all of that up, it comes to 30 billion. How far they will succeed, how much they will raise, and how much they will then contribute towards spreading this investment out into Indian businesses is for all of us to see. But this is more to give you a sense of size and scale. Though many domestic PE funds have come up, including spin-off of people who have moved out of probably large funds and they're starting on their own, etc., you will see that a lot of the money is still coming from abroad. LPs are becoming more discerning and hence you have a greater scrutiny on investment approach, discipline in terms of how disciplined the PE fund manager is, and the portfolio management skills. These are the three key things that will happen. It's not that you put your money and forget it. How are you managing the company? How are you going about actually helping the company create value? While PE funds have invested 8 billion, industry has also unwound about 5.3 billion from earlier investments during 2010. So now a time has come, it's not just people are putting money in India, PE investors have also taken money back. So last year itself it was 5.3 billion. So there is some amount of maturity and depth that is coming up in the market. However, obviously there are many things that probably one can speak about in terms of what can be improved in PE business, but I thought I'll put on the most critical one, which is effectively a expectation mismatch between PEs and the promoters over asset valuation. And this continues to remain a big issue as we speak. There are people who end up then paying more, and therefore when the exit comes, probably it doesn't make sense for us. It doesn't give us the return that a private equity investor is expecting, and that again puts the clock back. So this expectation mismatch is something which we'll have to continue to deal with, and it's a pretty serious, large issue. Demonstrating a strong track record and has become more important than ever today. I mean, I have to show that I have made money, I have invested well, I managed the companies well, sold, made money, and only then investors end up reposing their faith in you. In summary, activity is picking up, but competition is going to be intense. Now, competition is going to be intense means competition on all fronts. Competition by fund managers to ensure that they perform the best. Competition by companies to ensure that they give the best of governance, and they ensure that they are putting forth the more realistic and right businesses for PE funding, and of course managing it well. So the competition is on multiple fronts. Probably that will make the whole industry more efficient, which is good news. But yes, the activity is definitely picking up. With that, I think I'll just leave with any questions probably at the end of the session. Thanks.
We thank Mr. Laxman for making us aware of one of the most upcoming investment opportunity in the form of private equity and showing us the optimism involved in the same.